Today we're joined by Leah Willis, Head of Client Relationships at Australian Ethical, who will present the rise of ethical investing. So without further ado, I'd like to hand over to Leah.
Thanks. Thank you so much. Good morning and welcome, and thank you obviously to Hub for the opportunity to present on the rise of ethical investing this morning. I'll start off with a quick overview of what we're going to cover this morning. At Australian Ethical, but more broadly in investment markets and in consumers' lives overall, we're seeing this rise in consciousness in the way people consume goods and services. Broadly, people know that we can't continue to live the way we do if we want the planet to survive, and people actually want to be a part of that solution. Hence, we see an ever-increasing number in everyday lives of eco-friendly, no plastic and free-range options to help consumers make better choices. And at Australian Ethical and in investment markets, we're seeing this tip over into the way people are looking to invest and are looking to save for their superannuation and retirement, which is driving the growth of ethical investing or responsible investing. And what does this rising popularity mean for you? So today we'll quickly cover or touch on the growth of responsible investing, what is ethical investing and what does it look like in practice, and then the changing landscape and emerging opportunity for advice. In late 2017, Morningstar released a report showing the growth and the size of the sustainable investments globally. Sustainable assets stood at 23 trillion assets under management, which were up 25% over the 2-year period, and were estimated at 1/3 of the global assets. That says that $1 in $3 globally is now being invested with some focus on ESG or sustainable or SRI considerations. Based on this alone, we would argue that responsible investing is no longer an alternative investment choice for the deep green investor, but is rapidly entering the mainstream and out of niche. And it's a similar story if we turn to the Australian marketplace. The Responsible Investment Association of Australasia, or RIA, is the peak independent body that benchmarks responsible investing as a sector, its growth and its trends year on year. In their last report in 2018, the responsible investments accounted for $866 billion in total assets under management, which now represents $1 in $2 of professionally managed assets in the Australian marketplace. While the bulk of this responsible investing is categorised as broad on this chart and what we would consider as ESG investing, of note is the growth in core RI, which makes up sustainable, ethical and impact investing. This deeper part of the responsible investing marketplace actually grew by 26% in the last year that it was reported, and has actually quadrupled in the last 5 years, which shows the deepening of the screening and methodology that ESG investors, but more broadly responsible investors, are starting to adopt in portfolios. There is this deeper green approach that's emerging in the marketplace. We think this growth indicates responsible investing is not just a passing fad, but a persistent and growing trend that we'll see in investments and something that you should start to embrace. We see that this is supported by both bottom-up demand from consumers and top-down macro trends that will continue to support responsible investing. There is no question that bottom-up consumers are demanding and in fact expect more responsible investing from fund managers, super funds, and as we'll see later, from advisors. This was confirmed by RIA's consumer survey that they also did last year when they released their report. RIA found that 9 in 10 Australians expect their super to be invested responsibly. 7 in 10 would consider the social impact of a responsible fund more than just maximising returns as the outcome that they want to achieve. And 4 in 5 would actually proactively switch their super if they found that it didn't align with their values. The feedback from this survey is very clear to us that investors are no longer happy to see their super and savings associated with unethical or irresponsible activities, companies and sectors that they believe cause harm or in fact don't align with their own personal values. And then from a top-down perspective, the world's population is set to be 9 billion by 2035. This rapid population growth is leading to some massive or big social and environmental issues. This is reflected in the latest megatrend reports from the leading researchers at CSIRO, KPMG and PricewaterhouseCoopers. These recent reports identify some really strong themes that are coming out in the coming decades out to 2030 and 2050. Issues around efficiency, the environment, demographics, both at a millennials but also an ageing demographic of the population, technology and the emergence of technology, consumer power and urbanisation. These themes lend themselves perfectly to responsible investing or ethical portfolios. Ageing demographics means that we need and demand more healthcare, more pharmaceuticals and biomedical solutions, as well as aged care and health facilities. Climate change requires us to make a transition to cleaner, renewable sources of energy. And rapid urbanisation is leading to more green and sustainable building, transportation and food production, or alternative food production in some cases. This is all benefiting from consumer demand, and responsible and more sustainable investments all lend themselves to these themes. So we actually see that it's not just consumer demand that is supporting this growth in responsible investing, but in fact there's good social and economic fundamentals that will underpin the growing demand for more sustainable solutions and the stocks and the sectors that responsible investing is being driven to. So what is ethical investing? In Australia alone, there are 69 asset managers offering ethically or socially responsible or ESG funds of some sort, according to RIA's 2016 report. This was more than double the managers the previous year at 29. But what we know is with more choice comes more complexity for clients and more greenwashing of funds. What does responsible truly mean? And with no clear definition of responsible investing, particularly in the Australian marketplace, we've dubbed our approach to this as the shades of green, to help clients navigate what are the different options available to them, what do they really mean in terms of the types of exposures that they'll get, and helping them to navigate ultimately to make sure that they align their investments with the values that they're actually looking at trying to get out of their investments. So I'll quickly walk through this shades of green. Traditional investing considers risk and return trade-offs, the traditional type of investment fundamentals that we're all used to in finance and economics. They're focused on financial outcomes, but these returns may well be achieved through exposure to intended or otherwise to fossil fuels, weapons, animal cruelty, tobacco, gambling, and human rights or human slavery issues. Things that a client may seem or deem as harmful or irresponsible or unethical and may not align with their values. ESG, as we said, is the broad responsible investment part of the market and used by many global managers, ETF providers and index managers, all coming to Australia in spate over the last 12 months. They consider broad responsible investment considerations, ESG, environmental, social and governance considerations. But it's really the risks associated with those as part of the overall investment valuation process, rather than an intended exclusion of any particular sectors or stocks. We are seeing, though, that this is starting to deepen. We've now seen a global movement against tobacco and armaments. However, we still see this as a light green touch. There's still not a global recognition of climate change in many investors' portfolios. Then we move to core RI, which is a lighter green, which is a deeper green. And these funds go deeper and consider societal impact or purpose, such as excluding harm, including for positive, more sustainable sectors and stocks, being themed in some sustainable way to renewables and other sectors, or investing for community impact, such as social housing. Ethical investing is the very deep green spot part of this core RI segment, because we actually incorporate all aspects of responsible investing when we go through our investment approach. And I'll look at this in more detail over the coming slides. But first of all, in practice, what does this all mean? What we've done here is done a comparison of what we would regard as a traditional investment indice, which is the S&P ASX 200, a sustainability themed index, which is very commonly used here in the Australian marketplace by ESG providers, the Dow Jones Sustainable Index of Australia, and then our own portfolio. And we've aligned each of the top 10 stocks of those particular indices and portfolio. Looking at the top stocks across the ASX 300, the Dow Jones and our own Australian ethical portfolio, it is very clear the differences and in the shades of green from mainstream to ESG to ethical. I'll use one example and jump into the sustainable index. You'll see two stocks in particular which our fund doesn't hold, Tabcorp and Orica. And I want to pull these out as examples of these differences between the lighter shades of green and the deep green, and how you really need to look at the transparency of a portfolio to make sure that you're actually delivering on your clients' expectations of what is responsible. Tabcorp, for instance, offers wagering and gaming services and broadcasts horse racing at a time when Australia has the highest gambling rate per capita in the world. They were fined $45 million for breaching money laundering and anti-terrorism laws in 2017, and they've had the largest civil penalty in Australia's corporate history. Orica supplies commercial explosives for the mining, oil and gas sectors. In 2014, they were fined for releasing pollutants at its Kooragang and Botany plants, and back in 2012, they pleaded to releasing cyanide into the environment on 217 occasions. Others include Oil Search, Woodside Petroleum, Wesfarmers and Newcrest Mining. It's really important. We're not saying that any particular approach is right or wrong, but the most important thing is making sure that when clients are looking to exclude or are looking to align certain values in terms of their investments, that they are actually getting in reality what they're signing up for or wanting or demanding. And as an advisor, you have a really critical role in understanding the transparency underneath these portfolios to make sure that you are delivering on your clients' expectations. So when we moved to responsible investing, we saw that the shades of green was one way of thinking about it. The other way of thinking about it is the actual dimensions of responsible investing. So what actually goes into creating a responsible portfolio? And we see these as some of the key things. And from an academic perspective, these are the different levers or different approaches or different inputs that a responsible investor could utilise. So ESG integration we saw was the lightest touch. The negative screen, the positive screen, influencing companies, advocating or influencing government, and then the impact that those portfolios have, and actually being able to measure the tangible difference that responsible investing has from mainstream. And I'm going to refer to each of these in a little bit more detail as we run through the ethical investing process. This broadly shows you the negative screening process that we employ. We have an ethical charter that's been driving our business for over 30 years, but this is many of the exclusions that you'll see in a deeper green approach. We have negative screens for harmful sectors, such as the consideration of, for harmful sectors such as fossil fuels, coal and coal seam gas, but also consideration of animal testing and welfare, human rights in supply chains, and things like alcohol, tobacco and gambling. The most important thing, and where you should be asking your responsible investment fund manager, is about their exclusions, but also about their thresholds. We have revenue thresholds for most exclusions, but they're quite different for direct and indirect exposure. So direct exposure, for instance, would be tobacco, alcohol and gambling, production and manufacturing. Indirect involvement might be things like supermarkets that have exposure to those kind of sectors or assets or stocks through the sales or revenue that they produce. So I'll use an example. Star Entertainment is excluded for direct gambling because under our charter we deem this as harmful to people and society. But equally, Coles and Woolies derive quite a strong contribution of their revenue from the sale of these products and services. So we actually exclude Coles and Woolies on that basis. You probably wouldn't see that in an ESG or a lighter touch approach. For fossil fuels, it's similar. We have a straight exclusion for those, as I said, but we also do have an indirect exposure. So for many renewable companies, they still are reliant on fossil fuels as a backup, but we expect them to make a transition to 100% renewable. So we'll have a threshold in place for them to be able to make that transition. While we talk a lot in responsible investing about exclusions, I think it's actually moving to a much more positive and inclusive approach. And in fact, this is where investors are driving much more of the demand. While they don't expect or they don't demand harmful or irresponsible practices, they are actually, in fact, conversely demanding a stronger approach from fund managers in respect to the positives that you're taking in a portfolio and more sustainable products and solutions. So while the most market's focusing on exclusions, we're focusing on positives. And this approach identifies and invests in beneficial things such as IT, aged care, medical solutions, pharmaceuticals, responsible banking, and the list goes on. It's really important to note that as we go through that exclusion process, that of the ASX top 100, through that ethical screening of negatives and positives, we actually exclude 70% of the top 100 stocks or companies in the Australian marketplace. And because of that ethical charter, the portfolio looks very different from your mainstream, as we suggested up front. Heavy underweights to energy and materials, but significant overweights to positive and more sustainable things like healthcare, information technology, and utilities. And there's one common misconception that ethical investing or responsible investing means that you need to compromise when it comes to returns. And I've just put this in here as a proof point that over a very long period of time, we've been managing Aussie equities for well over 20 years, and we've outperformed both the main indice as well as our own indice, which is the small industrials, by a significant proportion. So that myth or perception is not true, and clients can actually contribute to significant positive outcomes for the planet and society while still saving for their future and their retirement. I wanted to very quickly touch on influencing for change. I said up front that there were dimensions that responsible investing takes in, and this is a really growing part. If you have deep ethical clients or clients that are looking for a deeper level of investment, they will be starting to ask about shareholder resolutions, advocating with regulators and government, and these are some of the issues that we attended to last year. Over the past 12 months, we had a broad range of initiatives that we advocated on. So we actually band together with on shareholder resolutions. We also collaborate with consumer groups such as CCR and also Market Forces. And we were proponents of resolutions on climate-related action, in particular with QBE, Origin, BHP and Santos, but also human rights issues on worker protection with Woolworths, and also Qantas on their association with the facilities at Nauru Detention Centre. But you can see a really broad range of things that we were advocating on through shareholder resolutions, through advocacy through the government, and also, as I said, with consumer groups. And then the output of all of that, we said the final stages of responsible investing was what is the actual impact that you're making? And this is a really new and growing trend. We've had the Sustainable Development Goals around for some time, but it's been tricky to be able to benchmark back to them. We now have some leading providers in the marketplace, including we use MISCI, to be able to benchmark the impact of your investments and the underlying companies and what are they contributing to in terms of those Sustainable Development Goals. Last year, we were pleased to be able to report that our portfolio had 2.2 times the impact of the overall share market on some of those really critical issues that the Sustainable Development Goals are trying to solve. So once again, proving that you have a positive outcome while also generating financial outcomes for your clients. And we believe in aligning our interests with that of the community, because one of the really important things about responsible investing is that you have a number of different stakeholders that you consider: clients, shareholders, employees, but also the community and society at large. So we give 10% of our profits back every year to a community grants program that actually supports grassroots efforts where our investments can't actually invest because they're not listed. They tend to be not-for-profit and social enterprise. We've now contributed $2.5 million over the last couple of years to quite a few and very broad and varied initiatives that are happening at community level. So that was really running through those aspects and really tangible examples, I hope, of how we deliver on those dimensions of responsible investing. That's our take on things, but it doesn't mean that everyone has a similar take. As we said, in responsible investing, there's no clear definition. So it's really important to think about those dimensions, think about what's important to your clients along those dimensions, and whether your fund manager and the particular portfolio that you're looking at, how it delivers on each of those dimensions. So what does that all mean for you as an advisor? We know from talking to advisors, this is only a small part of what you do today, and it probably is largely off the back of a few passionate clients, and we do tend to find that it is being more client-led. However, We do believe that with the number of clients and dollars being invested in responsible investing and this growing rapidly, there's a changing landscape for you, for our industry, but also the expectation of advice and the processes that you should go through with clients. From RIA's consumer survey, there were some really key takeouts for advisors. Nearly half of Australians expect, this is not whether they ask or not, they expect that you are delivering funds that align with their values. 24% of Australians will consider investing ethically in the next 12 months, and 53% will consider investing ethically in the next 1 to 5 years. So from this, we would broadly say that 1 in 2 consumers out there in the marketplace would expect you to consider their values and to consider investing ethically in the next 5 years. Further to that, we know from the latest investment trends report that there's a lack of advice, some confusion, and a lack of product as being impediments to consumers investing responsibly. So that's absolutely where you come in and you play a critical role to help clients align the right investment choices with the expectations for them of what is responsible. And this requires, as we said up front, navigating those choices of ESG, SRI and ethical. And I think it's important to note that while as an industry we've been servicing the baby boomers and the asset rich for some time, there is a changing dynamic happening around us. And whilst we don't necessarily believe that millennials are engaged or that they necessarily provide a good source for advice businesses, I think the landscape for us is changing. Fee for service opens up new opportunities to be able to provide values-based advice. And we say values rather than goals because we see this as the next step away from a business based on commissions to one that is really servicing the needs and goals of investors, moving to a true values-based and a much deeper conversation with clients. And we know that this demand is going to continue to grow as you see the demographics of superannuation. We now see millennials who are now aged 25 to 34-year-old in their prime, starting to work, starting to contribute in terms of SG, and we know that they will make up 2/3 of the workforce and will have over $700 billion in super assets in the next 10 years. This generation we also know is more engaged in their lifestyle choices and the impact of their choices on society and the planet than ever before. And you can see here from one of the Morgan Stanley's latest reports, 84% of millennials cite investing with a focus on some kind of social or environmental impact as a central goal. You don't see fees or performance in there, and we know that they are hygiene factors, but really it's the impact of their investments which is really taking centre stage. We thought it would be interesting to share with you some of our research on what is driving responsible investing in terms of what are the themes and issues. And I think this is really important so that you understand some of the hot topics. If you are going to start engaging in these more values-based conversations or asking people about issues or concerns or exclusions, what are some of the topics that you're likely to come across? We proactively understand our members and their issues, and we actually survey them each year, but this is also supported by RIA's consumer survey as well. Our membership values climate change and environment absolutely as the top issue that they consider, but also critical and very emerging issues that are coming up quite quickly are things like human rights, social welfare and animal cruelty and welfare. This may help you understand the questions you'll increasingly get from clients and the issues that you may need to consider in terms of your advice process. And there's lots of information in respect to those considerations that are supported by that RIA survey, as I said. So very finally, I wanted to make the point that values are not one-dimensional. It's important to remember this when you're actually communicating and engaging with your clients. So if you start to have a values-based conversation, it may be necessary to think in a much more multidimensional way. So supporting your clients through broader and great engagement around their lifestyle choices. And we do this through a range of guides, blogs and social media posts that you can hook into at any point in time. And then finally, we know that having a values-based conversation or thinking about ethics in respect to investment portfolios may be daunting. So what we've done is created a whole toolkit for advisors that's available on our website and through our BDM. Things around blogs and how we actually look at particular hot topics so that we can help, handhold you through some of those issues that might come up. an ebook that you can share with your clients around what is ethical investing, and then some of those values-based conversations or questions that you might want to integrate into your advice process. So I just wanted to really finally say that we are here to help. We think responsible investing is here to stay. We've been doing it for over 30 years, but we think the demand from advisors will continue to grow over the next decade, and we want to help you through that process. And so, as I said, a range of collateral available on the website. Great, thank you.
Thank you. Guys, we're now going to hand over to questions. So just a little reminder to use your webinar control panel to submit the questions through to the team. Looks like we've got two here already. So Leah, given that you've said the portfolio is so different to mainstream portfolios, does it mean that it's riskier?
Sure, we get that question a lot, both from a risk and a return perspective. And the simple answer is when we look at a risk-return profile of our portfolio, it actually happens to be lower risk and higher return than most of the or all of the mainstream indices, in fact, here in Australia. So we know for a fact that the outcome of our portfolio is not actually riskier. And in some respects, that's because we take out a lot of that concentration risk that we have in the Australian marketplace around resources and around banks. But there's also some of that ESG or governance risk and climate risk associated with those sectors as well. So we actually believe that by taking them out of the portfolio, we're actually removing some of those inherent risks from the portfolio.
Okay, great, thank you. Second question, given you were talking earlier about talking about with advisors and their role in the conversation about ethical investing, have you had any examples of advisors adopting a values conversation? And what's the feedback, client feedback?
Yeah, sure. We're really close to a group called the Ethical Co-op. Nationally, they've been doing this for the last couple of decades, and they do it very well and have passionate clients and understand to a much deeper level what the sorts of values and lifestyle choices of their clients are. More broadly, we've just finished a roadshow around the country, and we had one particular example where a particular financial advisor had started asking this question as part of the process, and she was really surprised to find that 7 in 10 clients had some kind of concern or ethical consideration or exclusion that they wanted within their portfolio. And this comes from a range of reasons. It's not just because they happen to be deep green or environmental. It might also be that from a lifestyle position, they've come across an example of alcoholism or gambling or any other kind of personal circumstance where they just don't want to have their investments funding those what they regard to be harmful or unethical sectors.
Great, thank you. We've had a third question come through. How connected are the Australian ethical funds in small cap and micro cap companies, since 70% of the ASX 100 are screened out?
That's a really good question. So yeah, absolutely. By default, because we can't invest in 70 of the top 100 stocks, we push down into the 200 and 300, and we do have a bias towards small cap and micro cap, in fact. And that's where we do find a lot of the green IT, the pharmaceutical, and in particular the renewables. If you think about a decade ago, there was very few renewables listed on the marketplace. They've moved into IPO and now moved into micro and small cap exposures in the market. So absolutely, we hold around, of the 30 top 100 stocks, we hold around 15 of those in our portfolio, and then around 50 stocks that go across the small and the micro cap.
Okay, great. Looks like we've reached the end of the questions, so if there are no more coming through, I might finish the session. Thank you everybody for dialing in, and thank you Leah, of course, for presenting. We will be sending out an email after the webinar with a copy of the presentation, and of course if you'd like to get in contact with Australian Ethical, please let your BDM know or send us an email to marketing@hub24.com.au and we'll be happy to put you in touch. Thank you again and have a lovely day.